We've been talking about circular economy, and we had a great session yesterday. So we're going to talk the VERGE Summit, the first of 4 VERGE Summits we're doing this week. We're going to shift gears now from where we've been talking on energy to talk about the circular economy, particularly. How do we finance it? To do that, please join me in welcoming the Ray C. Anderson Foundation Senior Fellow, Michael Molitor.
Thanks, Jim. See if I can get the slides to move. Okay. Like most of you that are passionate about this idea of a transition to circular economy, you're probably following GreenBiz. And if you're following circular economy on GreenBiz, you would have found the MacArthur Foundation. Right? And if you, like I did, typed MacArthurFoundation.org, you would have gotten their homepage, and then you would have seen this marvelous mission statement. Right? Our mission is to accelerate the transition to a circular economy. Fantastic. There's a great message there. And the message is that it's already started. Right? The Ellen MacArthur Foundation and GreenBiz and us and all of us who are interested in this idea, we don't have to get it rolling. It's already rolling. Our task is to make it bigger, make it happen faster, and better. Right? Because in the absence of somebody pushing this along, it's probably not going to evolve on a timescale meaningful to the challenges for which it was created. So as the senior fellow at the Ray C. Anderson Foundation, I don't quite have the resources or the network of the Ellen MacArthur Foundation, so I've got to try to pull a bigger lever. Right? So I ask a question that I think most people don't ask, and that is, what's the biggest problem that a transition to a circular economy can solve? What's the biggest problem? Because if you're going to accelerate this, and you need an order of magnitude a few $1 trillion to do it, right, then you're going to have to find a really big problem and really big, powerful interests with their resources and solve their problem. Right? If not, you're swimming up against a very big stream. OK, so there's 4 people on this slide. Whether you like it or not, they're now the new masters of the universe. Ben Bernanke, Janet Yellen, Mario Draghi, and Hirohiko Kuroda, the head of the Bank of Japan. Mario Draghi is head of the European Central Bank, and of course, Ben and Janet are the past and current chairman of the Fed. As the book, the New York Times bestseller, The Only Game in Town, makes it clear, this is where all the action is. Right? So the biggest problem on the planet today is reviving growth. They've had 8 years, and they spent $6 trillion, and we don't have much to show for it. Right? So I asked a crazy question. What if a transition to a circular economy helps solve the biggest problem on the planet? Now, the biggest problem on the planet may not be reviving growth, but in terms of attracting the interest of the most powerful people on the planet and engaging the largest amount of resources, this is now the world's biggest problem. Let me give you the good news and the bad news about this challenge. The good news is we don't have to worry about capital. There's a ridiculous amount of capital on the planet. In fact, institutional investors, pension funds, insurance, reinsurance, sovereign wealth funds, family offices, venture capital, private equity, hedge funds, between them, they control more than $100 trillion. Right? So there's plenty of capital. Here's the bad news in terms of my work. The majority of that capital is poorly allocated. Right? It's invested in companies who generate a positive financial return, but whose actual activities have a negative or low impact, have the impact of driving low growth or negative growth. And I'm arguing this is why growth is anemic. OK. All right. So how do we get to a situation where most of the world's capital is invested in companies that have either a negative impact on growth or a slightly positive impact on growth? It's very simple. The bulk of this capital, the overwhelming majority of this capital, chases only financial returns. What does that mean? What does risk-adjusted financial returns mean? It means that the majority of these fund managers, people managing all this money, they would rather invest in Krispy Kreme than invest in the Solar City Tesla. Why? Well, because the risk-adjusted return, the risk that they expose themselves to at Krispy Kreme is lower than the risk that they expose themselves to Solar City and Tesla. and the return that they get is at least as good, right? And so if your only focus is getting a risk-adjusted return, you don't ask the question, wait a minute, what's the impact of Krispy Kreme, right, in terms of generating growth? Krispy Kreme, fantastic financial returns, right? Negative impact on growth. Sorry, it's a bit of a delay in moving the slides. Okay, so here's what I did. I took the S&P 200, and I said, which companies have negative growth, which companies have zero growth, and which companies have low growth. So negative growth companies are companies that generate wonderful financial returns for institutional investors, but their actual activities, right, lead to a break on growth. Zero growth companies are companies that generate good financial returns, but have virtually no impact on lifting growth. And the low growth companies are ones that generate positive growth, right, but not on a scale meaningful to our challenges. We've typically averaged about 3% GDP growth. We're below 1%. If we don't bring that back up, we're in trouble. Low growth companies generate a positive impact on growth, but not on a scale relative to bringing us back to 3%. Excuse me. Okay. So what is it about these companies that generate positive financial returns but yet have a negative impact? They have low overall resource productivity. What does that mean? It means they deploy energy, natural resources, capital, and labor at levels of efficiency too low to drive growth, right? High growth companies have high ORP performance. There's three numbers there: 20 US trillion, 70 US trillion, and 305 US trillion dollars. The 305 trillion is the estimate by the OECD in Paris about how large the global economy needs to be in the year 2050 if we're going to meet the growing aspirations of a population on its way to 9.5 billion and 2.5 new middle-class consumers. The 70 trillion is where we are today, and the 20 trillion is one think tank's idea of where we need to return to if we're going to sort of stabilize. Here's the takeaway message. Regardless of which level of growth you want, there's no way to get there, right, without the overall resource productivity improvements that are generated by a circular economy model. And I'll list two companies. Veolia, they move more garbage than any other company in the world, and Michelin, you know them, they make tires. Veolia, how do they make money? What's their existing model? They have a negative growth model. They get a fee for picking up your garbage, they get a fee for hauling it, and they get a fee for storing it and managing a landfill. They're now saying that business is flat. We can't generate the type of growth that we need and our institutional investors need. We're going to move to a new model. We're going to extract materials from those waste streams. We're going to upscale them into high-value products. We're going to build new factories to do that, and we're going to generate a substantially better model, a bigger market, right, and substantially better overall resource productivity. Michelin, the same thing. They make millions of tires a year with a fossil fuel value chain that's super volatile in terms of its prices, super dirty industry, right? And there's 800, 900 million used tires being thrown away every single year. That's substantially more than the total tires they make every year. Why not find some way to recycle them and then ultimately create a tire that's designed to be leased and not sold, where you can recycle every molecule at the end of life, right? So these are examples of circular economy companies who are dramatically improving overall resource productivity. All right, where's the money going to come from? Right. Pension funds are in serious trouble, right? So of that 100 trillion, they've got 63 trillion, right? So they're the big player. They're facing the biggest perfect storm in their history. Right. They have exponentially increasing liabilities because of the demographic transition and boomers entering retirement, at the same time that their traditional investment universe is shrinking. US pension funds as a group are about 2 trillion underwater today. CalPERS, maybe some of you in the room are beneficiaries of the CalPERS system. Their 20-year annualized returns above 7.5%. Last year, 0.6. Right? So pension funds, more than any other group on the planet that has significant amounts of capital, they need to see growth come back. when you talk to them about their portfolios, the majority of their portfolio is in Krispy Kreme. In those companies that generate a healthy financial return, but whose actual activities act as a drag on growth, okay? So pension funds, my argument to them when I speak to them is they're their own worst enemy, right? Because their portfolio now reflects the reality of negative and zero growth. Okay, this is my last slide. So what's the answer, right? We have a very, very large group of institutional investors in serious trouble. We need about $2 trillion a year. That's our calculation. $2 trillion a year to allow companies like Veolia and others that have low growth models or negative growth models to transition to high growth, as well as supporting the high growth companies. So here's the formula, right? Move $2 trillion a year, right? To give you an idea, the IEA says the amount of investment that we need to 2030 to keep expanding the fossil fuel stationary energy system is $57 trillion. We need a lot less than that, right? So keeping the existing system going is significantly more expensive than making this transition. Invest in high growth companies, support low and negative growth companies to shift to a high growth model, and short sell the laggards. I want to thank 3 people. I want to thank Joel and the amazing team at VERGE 2016 for inviting me. I want to thank this guy, Ray C. Anderson. I had the pleasure of meeting Ray on several occasions. There's no question that I wouldn't be here doing what I'm doing now if it wasn't for Ray. And finally, I want to thank all of you for putting up with me for 10 minutes. Cheers.